My name is Richard Stuebi. I'm a lecturer in the Department of Strategy and Innovation at Questrom. I'm also affiliated faculty at the Institute for Global Sustainability. I've been in the energy industry my entire 35-year career now. And as a result of that, I am leading the energy and sustainability programmatic offerings, as well as curriculum development and teaching at Questrom in the energy and sustainability arena. A good starting point for this question is understanding that the global oil market is approximately 100 million barrels a day. It's a staggering volume, but what underlies that staggering volume is that small changes in volumes of demand can lead to very big changes in prices. So at the beginning of the pandemic, global oil demand being roughly 100 million barrels a day, when the lockdown occurred and everyone just retrenched and stayed at home and no one traveled and a lot of commercial activity reduced, oil demand went down by about 10%. So it went from about 100 million barrels a day to 90 million barrels a day, but oil prices collapsed. They went from about $60 a barrel to $20 a barrel very quickly. And so what's happening now is that as the global economy is emerging from the pandemic, and in fact, I would say that it's really surging. There's a lot of pent-up demand for travel from the past 2 years that's been stifled. A lot of savings that people haven't spent because they haven't gone out and eaten much in restaurants and done much traveling. So there's actually quite a bit of almost a springback effect where demand now has exceeded what oil demand was before the pandemic. And so that, whereas oil demand was roughly 100 million barrels a day before COVID, went down for a few months or 6 months down to 90 million barrels a day. It's now gradually eked back up to where it's about 102, 103 million barrels a day of oil demand. And that is one of the driving factors for why oil prices have not only rebounded to where they were, but far beyond that to over $100 a barrel now. So the U.S. is certainly one of the largest producers of oil in the world. In fact, for a period there right before COVID, it had surpassed Saudi Arabia and Russia, both of whom are about equally large, in becoming the #1 oil producer. All three of those countries were around 10, 11, 12 million barrels a day. So all three of those countries roughly represent collectively about a third of the global oil market. The U.S. could ramp up production. But what is happening in the world today is that the demand growth that we're seeing in the wake of the COVID rebound is not expected to last very long, because under what's happening behind the scenes is that there's a massive shift emerging away from gasoline and diesel vehicles to electric vehicles. And so as the global fleet of vehicles shifts away from burning oil-based fuels to electricity as their prime mover, the demand for oil is expected to peak in the next few years and begin declining. When the oil production or demand reaches its peak is unclear and the subject of a great deal of controversy. But even OPEC, the Middle Eastern producers who really dominate the world oil market, expect that oil demand will peak between now and 2040 and then decline thereafter. What that means is that even though the U.S. has significant oil resources that could be added to and expanded upon, capital markets and the financial investors behind the capital markets are skeptical that investing more capital to expand production in the United States is going to have a very good return for very long. And so as a result, it's not so much that regulatory forces are putting constraints on oil production, but rather a combination of capital markets and the management teams of the major oil producers in the United States saying, let's be very cautious about making additional investments to expand production, and instead If the oil prices are high, we're very profitable at those high oil prices. If we expand production, we'll drop oil prices, and that's not necessarily the thing that increases our profitability. So we're going to be very disciplined in how we think about expanding production in the United States. So as a result, you really haven't seen much additional production in the US, even though, frankly, if we wanted to expand production by 10, 20, 30%, that could very profitably probably be done at $70 or $80 a barrel. The oil markets are an essential barometer for anything and everything that happens in the world energy marketplace. There's a move afoot to decarbonize our global energy system to mitigate climate change, to meet the targets of the Paris Agreement of 2015, nearly full decarbonization of the global energy system will have to happen in the next 30 years. The competitiveness of clean energy sources to wean ourselves off of fossil fuels is obviously largely affected by what the prices of those fossil fuels are. So as oil prices rise, and they're over $100 a barrel now, a lot more clean energy sources like solar, like wind, like electric vehicles, start looking a lot more economically attractive than when oil prices are $20 or $30 a barrel. So the high oil prices, in one respect, make it much more economically attractive to shift to energy sources that are not based on fossil fuels. On the other hand, if high fossil fuel energy prices are going to drive declines in economic activity, a recession, and potentially also deteriorating returns in financial markets and declines in the stock market, that's going to reduce the availability of capital to invest in new energy technologies or new deployments of clean energy sources. So in many respects, what all parties in the energy sector, both the fossil fuel sector as well as the clean energy sector, really benefit from sort of a Goldilocks range of energy prices, where oil prices are in a moderate range of $50 to $75 a barrel. It's still plenty profitable for the oil companies. It still makes for reasonably attractive investment return potential for alternative energy sources, and it keeps economies healthy and the financial markets healthy to finance all of the investments that need to happen to make this big transition in the global energy sector. Global oil markets by nature are global. The U.S. is a significant player in it. As I mentioned, they're about 10 or 15% of the U.S. is about 10 or 15% of global supply. And there's always things that can be done on the margin to induce or improve the ability to expand production. But in general, the main drivers of global oil markets are twofold. One, what does OPEC want to do? And two, what is the nature or state of demand for oil in the global marketplace? When you think about those two things, the ability for any presidential administration is to have significant influence on either of those two factors is quite limited, frankly. So, while I think it's always convenient for the American public to look to Washington, D.C. for a solution to a problem that, may be perceived to be dire, but at the same time might actually be relatively transitory. The truth of the matter is this is going to be settled. Oil prices will only equilibrate when and as both the supply side and the demand side of the oil markets are stable. And in point of fact, on the supply side, oil markets are not stable because of the Russian-Ukrainian war has significantly disrupted who can supply oil to whom. And on the demand side, you have this very almost bipolar phenomenon that's occurring, which is in the immediate term, there's a real high increase in oil consumption for people traveling and resuming their travel in the wake of COVID. But in the intermediate or long term, there's a real sense that oil demand will actually start falling because electric vehicle adoption rates, which are accelerating tremendously, will significantly start reducing the demand for oil for vehicular transportation. So the dynamics of the oil market are such that no presidential administration can have a significant influence on it, really. And oil market dynamics are, frankly, in a situation where it's going to be volatile for many years, maybe decades to come. As I mentioned earlier, the global oil markets are around 100 million barrels a day, and it doesn't take much perturbations below 100 million barrels a day or above 100 million barrels a day for market prices to vary tremendously. If we are to move off of oil in the next 30 years, and so a 100 million barrel per day market falls to 20, 30 million barrels a day, every step in reduction from 100 million barrels a day down to 10, 20, 30 million barrels a day, you pick the number, is going to be a very fine balancing act between will supply be declining or withdrawn faster than demand falls, or vice versa. If demand declines faster than supply does, oil market prices will collapse. If oil supply and expansion of production decreases faster than demand decreases, oil market prices will skyrocket. And in turn, each one of those phenomena sets in motion its own re-equilibrating phenomenon. When oil prices are really high, like they have been recently, even though this summer people are driving a lot, I think in the fall you're going to see a lot less energy and oil demand as people get their summer vacations out of their systems for the past couple of years, and then hunker down again, and oil prices will begin to fall. Vice versa, when oil prices are really cheap, demand increases again. So I think in the long run, what we as individuals have to become accustomed to is a world of increasing oil market price volatility, and to expect that the government or oil companies will step in and keep prices at in this ideal Goldilocks range is hopeful, and maybe if we're lucky, most of the time it will be in a moderate range. But I think we need to expect that there will be times when the supply-demand balance will be very far out of whack, as it is today. And in today's economy, the supply is tight relative to demand. But in a couple years, just like it was in 2020, the demand could be really far below supply, and you'll see really low prices. I think that type of, even though I'm not expecting, or I'm hoping that COVID doesn't keep resurging every year for the next 20 years, but the general trajectory or the general pattern of oil pricing in the past few years, I think is kind of the flavor of how oil markets will behave for quite a long time. The global energy sector is one of the largest segments of the global economy. It's on the order of $10 trillion a year in terms of annual expenditures. It's on the order of $2 or $3 trillion a year of investments. BlackRock, the large money manager, one of the world's largest, suspects that we're talking about $100 trillion of investment that needs to happen in energy in the next 30 years to transform it from the sector that exists today to a decarbonized sector consistent with managing climate change. This is going to be one of the biggest industrial transformations that has ever occurred in the history of humanity. Almost everything that we take for granted in today's society, in today's economy, the way consumers consume things, the way that producers produce things, the way that we move around, the way that goods get shipped and utilized, almost everything is going to change quite dramatically in the next 30 years. And so becoming knowledgeable and familiar with the dynamics at stake in the energy sector really redounds to everyone's benefit, not only because it could be a great area in which to make a career or to create fabulous wealth, but even for those people who don't pursue an interest in energy, no matter what sector you're in, whether it's finance or retail or healthcare or operations, the way that energy, the way the energy industry will evolve will have dramatic impacts on almost anything that you might choose to pursue in one's career. So I encourage those of you who are interested in these topics. I'm happy to discuss any of these topics at length. Feel free to reach out to me, and hopefully you can get a sense for there's reason to be optimistic about where things are going in energy. On the other hand, it requires a lot of dedication and commitment and passion, and hopefully maybe you'll want to make a dent in that yourself.